Welcome to Financial Accounting Reports, Understanding the Income Statement. Important facts about the income statement are: the income statement is prepared for an economic or business entity. It's prepared for a period of time. For example, an income statement can be prepared for a month, a quarter, or a year. The income statement includes revenues, expenses, and net income. Net income is equal to revenues minus expenses. Income statements can be prepared in different formats. For example, a single step, a multiple step, or a hybrid. The format just refers to the way the income statement is put together. The same information is used regardless of the format. Income statements are also referred to as profit and loss statements, or P&L, statement of operations, statement of financial performance. Here we have Google, an economic entity that has something to say. Accounting is the language of business, so accounting helps Google communicate its income for the period. In this case, Google is preparing an income statement for a one-year period and actually presents three different one-year period results. We see that revenues, expenses, and net income are reported on the income statement. So what is revenue? Revenue is the price that's charged for providing goods or services. Revenue is recognized in the income statement when the good or service is provided. This means that cash can be received before the good or service is provided, cash can be received after the good or service is provided, and cash can be received at the same time the good or service is provided. Regardless of when cash is received, revenue is recognized when the good or service is provided. Recognized is just another way of saying when is it reported on the income statement. So let's take a look at an example. On December 31st, 2011, Sally ordered a pizza from Great Pizza Company. The pizza is immediately delivered to Sally, and she paid for the pizza when it was delivered. So if we take a look at our timeline, what happened on December 31st? The pizza was delivered and cash was received. We know that revenue is recognized when the pizza is delivered. So let's take a look at how this affects the financial statements on 12/31. We know that on 12/31 the pizza was delivered. That means that revenue increases. Remember, revenue is recognized when a good or service is provided. So since the pizza was delivered, revenue increases. If revenue increases, net income increases. Remember from the previous module, net income is a part of retained earnings, and when retained earnings goes up, equity goes up as well. The second thing is cash was received. Cash is an asset, so asset goes up. So the result of the transaction of pizza being delivered and cash being received is an increase in revenue, net income and equity, and assets. Another example. On December 31st, 2011, Sally ordered pizza from Great Pizza Company for a party that she is having next month. She paid for the pizza when she made the order. So taking a look at our timeline, what happened? Well, the pizza isn't going to be delivered until the future, but on December 31st, the cash is received, but revenue is not recognized until the pizza is delivered. So what are the financial statement effects as of 12/31? On 12/31, Great Pizza Company incurred an obligation to deliver pizza in the future. An obligation to deliver means that Great Pizza Company now has a liability. Recall that a liability is a future economic sacrifice or an obligation. So we have an increase in our liabilities because we have to deliver pizza in the future. We're receiving cash today. Cash is an asset, so assets go up. The result of this transaction is an increase in liability and an increase in assets. the next example. On December 31st, 2011, Sally ordered pizza from Great Pizza Company for a party on New Year's Eve. The owner knows Sally and agreed to send her a bill for the pizza. So what happened on 12/31? The pizza was delivered, and the customer promises to pay later. The cash will hopefully be received at some point in the future. Revenue is still recognized when the pizza is delivered, although the cash isn't to be received till some point in the future. So let's take a look at how this affects the financial statements. What happened on 12/31? First, the pizza is delivered. Given that the pizza was delivered, we have an increase in revenue. When revenue increases, net income increases as well. Recall that net income is part of retained earnings is part of equity, so equity increases. Anytime there's a change in net income, there's also an equal change in equity. The other thing that happened is the customer promised to pay later. Although we're not receiving cash, we're receiving a promise to receive cash in the future. That means we have a future economic benefit. If we expect to get benefit in the future, and in this case we do, we have an asset. So we have an increase in assets. The result of this transaction is an increase in revenues, net income, and equity, and also assets. Now let's take a look at expenses. Expenses are the costs of goods and services used in the process of generating revenues. Expenses are recognized in the income statement when the good or service is used. Just like before, cash can be paid before the good or service is used, after the good or service is used, or at the same time the good or service is used. Let's take a look at an example. We still have our pizza company, and Johnny provided delivery service for Great Pizza Company, and Johnny was paid for his services at the end of the shift. So what happened on 12/31? Great Pizza Company used Johnny's delivery service, and they also paid Johnny. Delivery service is a cost associated with providing the pizza. The expense, the use of the delivery service, is recognized when the service is used. So let's see the financial statement effect. On 12/31, the service was used. Since the service was used, expense increases, net income decreases because the expense went up, and net income caused retained earnings to go down, which caused equity to go down. Always remember, equity changes the same way net income changes. Also, cash was paid to Johnny on 12/31 by Great Pizza. Cash is an asset. Since cash is going out, assets are going down. Our next example. On December 31st, Fresh Produce Inc. delivered produce to Great Pizza Company. All of the produce was used by Great Pizza that day. Fresh sent an invoice to Great. Let's see what happened. Produce was used, and an obligation to pay was incurred. The expense is going to be recognized when the product is used, even though the cash has not been paid. How does this affect our financial statements? The produce was used. We know that we recognize an expense anytime we use a product or service. So since we used produce, we have an expense. Expense causes net income to go down. Decrease in net income causes equity to go down. We also incurred an obligation to pay. An obligation is a liability, so our liabilities are increasing. So let's review. The income statement is prepared for an economic or business entity for a period of time. Common time periods are months, quarters, and years. Revenues minus expenses are equal to net income. Revenues are the price charged for providing a good or service. Revenues are recognized when the good or service is provided. and receipt of cash may precede, follow, or occur at the same time as revenue recognition. Expenses are the cost of goods or services used to generate revenues. Expenses are recognized when the good or service is used, and the payment of cash may precede, follow, or occur at the same time as expense recognition.